Good afternoon, ladies and gentlemen. My name is Dikonelo Boasi. My role is that of Head of Special Projects within the Government Pension Member Forum. What the Special Projects focuses on is mainly to educate members of this forum. We shall be hosting a number of sessions like this one, this tax planning workshop being the first of what we hope will be many, and we hope you will greatly benefit from these sessions. On the 22nd of February 2023, the Minister of Finance presented the 2023-24 budget. The purpose of this tax planning workshop is to highlight and give a summary of aspects that came out of the budget speech that may have an impact on members of this forum. The key changes that came out of this year's budget speech that may directly affect members of GRAF are adjustments of the personal income tax brackets and tax rebates. These were increased by 4.9%, as well as the increase in tax brackets for retirement lump sums. By retirement lump sums, we're including both at retirement and before retirement. And these tax brackets were increased by 10%. We will go into further details as we go into the presentation. To illustrate these changes and how you may be impacted, I will use one scenario, one case study, and compare what the tax implications would have been in the previous tax year compared to the current tax year. The following will be the tax implications that will be covered in this brief presentation. Retirement lump sums. That's when a member decides to retire, the lump sum that they take home with them. What tax implications will there be? Income tax. So once you retire, you get your monthly pension. What income tax implications will there be? As well as if you decide to resign and cash your money and take your entire resignation benefit, what tax implications will there be? I also hope that this presentation will lay a good foundation to understanding of future presentations that will be hosted by GRAF, as has been previously, as well as for your own personal tax obligations going forward. So, as mentioned previously, we will be using a case study. We'll be using one throughout the entire presentation. So our member is 60 years old, has got 24 years of service with no pre-1998 service, as that would have had implications as to the amount of tax-free lump sum that he may be entitled to. So we don't want to confuse the issues right now. So there is no pre-1998 service. The resignation benefit that is estimated on the GEPF benefit statement is 4,500,000, and the lump sum that the member is entitled to get, that once-off lump sum, is 1.5 million. And because they were going on retirement, they've got their pension. The pension will be 20,000 per month, and obviously per annum will be 240,000. Okay, so let's carry on and see how the different scenarios would affect this member of ours. We will start now with the tax lump sum. These are the two tax tables, as you can see. The previous tax table, the 2022-2023 tax year, the tax-free amount was 500,000. So that meant if you were to take home a lump sum of 500,000, there would be no tax payable on that. In the current tax year, this has been increased, as mentioned earlier, that it's been increased by 10%. So now 550,000 is what you're allowed to take home without it being taxed. As you can see, all the other tax brackets have also been increased by 10%. I won't go through each of them. But also an interesting thing to note, the tax brackets have been increased, but the actual tax rates have not been increased. So we still start with 18%, then 27%, then 36%, same as in the current tax year, 18%, 27%, 36%. So these are the tax tables that are used to calculate your actual tax payable on whatever lump sum that you would be taking home on retirement. So let's see how our case study member would fare. So we said they would be taking home 1.5 million, right? In the previous tax year, the lump sum would be 1.5 million. The tax-free amount that they'd be entitled to is 500,000, which means that the taxable amount is 1 million. So on the 1 million, how much tax is payable? 290,500. What will then be left off to be paid into the member's account is that amount. Okay. In the current tax year, the same lump sum that's been taken home, but now the difference is that the tax-free amount is 550,000. What will be the taxable amount? Will be 950,000. And the tax payable on that will be 267,750. So what will be paid into the member's bank account will be slightly higher in the current tax year as compared to the previous tax year. To be exact, a member by retiring in this tax year would have an additional 24,750,000 to go home with. I hope that's clear. Now, we said our member has 20,000 as an income. Now, how is the income? What are the income tax implications of that? These are our income tax tables from the previous tax year and for the current tax year. As we said, the tax rates have not been adjusted even for the income tax. So we still got 18%, 26%, 31%. So the actual rates of tax have not been adjusted. What has been adjusted is the brackets. They have been increased by 4.9%. And you can see that 226,000 and it's been increased to 237,100. What is also interesting to note is that the tax-free threshold, so your income that you would not pay tax on, has been increased from 91,250,000 to 95,750,000. What this means is that somebody who earns per annum 95,000 rands will not pay any tax. Okay. What also has an impact on the amount of tax that we pay, on the amount of income tax that we pay, is something called a tax rebate. You may be asking, what is a tax rebate? A tax rebate is an amount that Sars reduces the amount of tax that you're supposed to pay. So let's use an example. You earn an income, Sars works out that you must pay tax of 60,000. On that 60,000 rand, you may be, depending on how old you are. So if you're under the age of 65 years old, the tax rebate that you'd be entitled to, so meaning the amount that they could reduce, that your tax bill would be reduced by 17,235 rands. Previously, it was 16,425. So what this shows is that you are now paying slightly less tax. So it's been reduced. Your rebate has been increased from 16,425 to 17,235. If you are you have an income and you're over the age of 65 years old, you will be entitled to the primary rebate, which is 17,235, plus a secondary rebate of 9,444,000. And if you're over the age of 75, then you'll be entitled to all three of these rebates. Now, going back to our member, their income per month is 20,000, per annum 240,000. So the tax payable on 240,000 is 44,320,000. But we mentioned the tax rebate. So in the previous tax year, the tax rebate was 16,425. So when we reduce our tax amount that's payable, we reduce it by the rebate. What would be left is 27,895 rands. But that is the amount payable for the year. Our member is earning a salary per month, so the tax would be payable per month. So we would then reduce the annual tax payable divided by 12, and the tax that would be payable would be 2,325 per month. This is in the previous tax year. In the current tax year, same calculation, the tax payable would be 43,432, but our rebate has also increased to 17,235. So the amount of income tax payable has also reduced to 26,197,000. So per month, the tax that this member would pay, income tax that this member would pay, would then be reduced from 2,325 in the previous tax year to 2,183 in the current tax year, meaning that per month they would pay 142 rands less income tax. Okay, so now our member, we have just now looked at the scenario where they are retiring. They're retiring, they've got their lump sum, they take their lump sum, whatever's left purchases a pension for them. What happens if that member does not wish to retire, does not wish to purchase a pension, wishes instead to take their full resignation benefit that has been estimated at 4.5 million, wishes to take the full amount as cash to be paid into their bank account? What would be the tax implications in that case? So with this scenario, there will be no income tax implications unless they buy a discretionary investment somewhere, but we will not do that calculation here. We're just taking it that they're taking the 4.5 million and they want to take it all and have it that deposited into their bank account. We will now use the retirement fund lump sum tax tables, but now looking at the withdrawal benefits because they are now resigning instead of retiring. Okay. So in the previous tax year, the 2022-23 tax year, the tax-free amount was 25,000. This is as opposed to with the retirement where it was 500,000. So with resigning and cashing your benefit, the tax-free amount is 25,000. As mentioned at the beginning of the presentation, these tax brackets have also been increased by 10%. So 10% of 25,000 works out to be 2,500. So that tax-free amount in the new tax year, the 2023-24 tax year, increases from 25,000 to 27,500. So increasing by that 10%. So are all the other tax brackets. They've all increased, as you can see, by 10%. What hasn't increased, as with all the other calculations that we've done in the tax table that we've looked at, the actual rates of tax have not increased. We still got 18%, 27%, and 36%. So what remains? The tax rates remain unchanged, but the tax brackets have increased by 10%. So what will the actual calculation of a person taking their full resignation benefit look like? In the 2022-23 tax year, which is the previous tax year, you would have your resignation benefit of 4.5 million. The tax-free amount working out to be 25,000. So the taxable amount is 4,475,000. That's what the tax will be charged on. That's how much tax will be charged on. So the tax payable would be 1,467,000. So basically, what you do, you now so that's how much tax the member has to pay, and what will be left off to be paid into their bank account will be 3,033,000. That's in the previous tax year. In the current tax year, we still got our same amount, but the tax-free amount has now increased to 27,500. The taxable amount has reduced slightly because our tax-free amount has increased. So that is now 4,472,500. So the tax payable has also reduced slightly to 1,451,700. How much will actually be paid in the member's bank account will be 3,048,300 in the current tax year. What this works out to be is that the member will now go home with 15,300 more than what they would have gone home had they resigned in the previous tax year. This, ladies and gentlemen, brings us to the end of our presentation. I hope the information and the explanations have been clear and have not caused further confusion. If there are any questions, kindly post them in the forum on the Facebook group, and we'll ensure that they'll be addressed. As this is unfortunately not a live session, so we can't take live questions. But I'd be very happy to take questions and just address them. Also, if there are any topics that you would like such a session on, um, please feel free to suggest those, and we will also give more information on them. And where necessary, we may even invite the relevant organizations that may provide us with further information on such topics. Thank you very much for your time. I hope this has been of benefit to you. Thank you.